You walk into your bank tomorrow morning to withdraw your money. All of it. The teller says, "I'm sorry, we don't have it." "What do you mean you don't have it? It's my money." "Sir, it's everyone's money, and it's not actually here." This sounds like a nightmare, but it's not fiction. It's how banking actually works. And when everyone realizes it at the same time, that's when the panic begins. This is the story of what happens when everyone tries to get their money back at once. Here's the secret your bank doesn't advertise. Your money isn't there. When you deposit $1,000, the bank doesn't put it in a vault with your name on it. They keep maybe $100 and loan out the other $900 to someone buying a car, a house, a business. This is called fractional reserve banking. The bank only keeps a fraction, usually around 10%, and lends out the rest. Why? Because that's how banks make money. They pay you 0.5% interest on your savings and charge the borrower 6% on the loan. The spread is their profit. This works perfectly fine, under one condition, that not everyone wants their money back at the same time. But what happens when that condition breaks? Chaos. September 14th, 2007, England. A perfectly ordinary Friday morning. Then the news breaks. Northern Rock, one of Britain's largest mortgage lenders, has asked the Bank of England for emergency funding. Translation: they're in trouble. Within hours, the word spreads. The bank is in trouble. Get your money out, now. By noon, the lines begin. By afternoon, they stretch around entire city blocks, people standing for hours, desperate to withdraw their savings before it's too late. TV cameras arrive. The images go global. Thousands of people in queues, panic on their faces, banging on locked doors when banks close for the day. Over the weekend, people camp outside branches. Security guards are hired. Police monitor the crowds. The British government begs people to stop. Your deposits are safe, but no one believes them. In just 3 days, depositors withdrew over £2 billion. That's roughly $4 billion US. Gone. Northern Rock didn't collapse because it made bad decisions. It collapsed because everyone tried to get their money at the same time, and the bank didn't have it. The government eventually had to nationalize it. This was 2007, in England, a modern, developed economy, and it still happened. Here's how a bank run becomes a death spiral. Stage 1. Rumor. Someone hears the bank might be in trouble. Maybe it's true, maybe it's not. Doesn't matter. Stage 2. Concern. A few people withdraw their money just to be safe. Better safe than sorry. Stage 3. Visibility. Others see people withdrawing. Wait, why are they pulling their money? Do they know something I don't? Stage 4. Panic. Lines form. TV cameras show up. Now everyone knows the run is on. Stage 5. Acceleration. The bank has to sell assets to cover withdrawals. They sell at a loss because they need cash now. This makes their financial position worse. Stage 6. Collapse. The bank runs out of liquid cash. They close doors. People who waited too long lose everything. Unless the government steps in. The cruel irony? The bank might have been completely fine before the run started. But once the panic begins, it becomes a self-fulfilling prophecy. Fear destroys the bank, not fundamentals. If you think Northern Rock was bad, let me tell you about the 1930s. October 1929, the stock market crashes. Banks had invested heavily in stocks. Now those investments are worthless. People panic. If the market crashed, the banks must be failing. They rush to withdraw. In 1930 alone, over 1,300 banks failed in the United States. Not because they were all incompetent, but because people were terrified. The scenes were apocalyptic. Thousands of people outside bank doors begging to get in. Families losing their entire life savings when the bank shut down. No FDIC insurance back then. If your bank failed, your money was just gone. By 1933, over 9,000 banks had collapsed. 9,000. The banking system of the wealthiest nation on earth nearly ceased to exist. President Roosevelt had to declare a bank holiday, a nice way of saying he closed every bank in America for 4 days to stop the bleeding. When they reopened, only the stable ones were allowed to operate. That's when the government created the FDIC, Federal Deposit Insurance Corporation, to insure deposits up to $250,000. The message? Even if your bank fails, your money is protected. It worked. Bank runs became rare. But they never disappeared. So why do banks operate this way? Why not just keep everyone's money in the vault? Because the economy wouldn't function. Think about it. If banks kept 100% of deposits locked away, they couldn't make loans. No loans means no mortgages, no business expansion, no car financing. The economy would freeze. Fractional reserve banking allows money to multiply. Your $1,000 deposit becomes $900 loaned to someone else, who deposits it in another bank, which loans out $810 of it, and so on. That original $1,000 becomes $10,000 in the economy through this multiplier effect. It's brilliant. It creates growth, opportunity, wealth. It's also fragile. The whole system depends on trust. Trust that the bank is stable. Trust that you can get your money when you need it. Trust that not everyone will panic at once. Break that trust, and the entire system can collapse in days. You might think that was 2007. We've learned our lesson. Have we? March 2023. Silicon Valley Bank collapses in 48 hours, the second largest bank failure in U.S. history. Depositors tried to withdraw $42 billion in a single day. The bank didn't have it. The speed was unprecedented. In the 1930s, bank runs took weeks. In 2007, days. In 2023, hours. Why? Because you don't need to stand in line anymore. You can withdraw your entire life savings from your phone while sitting on your couch. Digital bank runs happen at the speed of panic tweets and group chats. The tools that make banking convenient also make it vulnerable. And here's the scary part. Most people still don't understand how fractional reserve banking works. They think their money is sitting in the vault, when they discover it's not, when everyone discovers it at once. Panic spreads faster than ever before. The next bank run won't be people in lines. It'll be servers crashing from withdrawal requests. So what happens if everyone withdraws their money at once? The bank fails, even if it was perfectly healthy before. This is the paradox of banking. It works brilliantly when everyone trusts it, and collapses instantly when they don't. Your money is both there and not there. It exists as numbers in an account, but those numbers represent loans to other people, investments in bonds, mortgages on houses. It's everywhere and nowhere. This isn't a scam. It's not fraud. It's the foundation of modern finance, and it's extraordinarily fragile. The system survives on a collective agreement not to panic. The moment that agreement breaks, the moment fear overrides logic, everything can unravel. That's why governments insure deposits, why central banks act as lenders of last resort, why regulators monitor banks obsessively. Because they know the truth. The entire system is built on trust, and trust can evaporate overnight. What happens if everyone withdraws their money at once? We already know. We've seen it in 1933, in 2007, in 2023. The answer is always the same. Panic, collapse, chaos. Your money is safe until everyone decides it's not, and then it isn't. The banking system is both a miracle of human cooperation and a collective delusion. It works because we believe it works. The day we stop believing, that's the day you'll understand what a real bank run looks like. Do you think your money is safe? Would you join the run if you saw lines forming? Let me know in the comments. And if this blew your mind, subscribe, because financial history is full of secrets hiding in plain sight.